Welcome to Ask the Experts. I'm Jill Schlesinger, editor-at-large of MoneyWatch.com. I'm joined by
Jack Otter, executive editor of MoneyWatch.com.
And to my right,
and Ray Martin, special contributor for MoneyWatch.com.
Oh,
and musical guest.
And musical guest star, Ray Martin. We were going to do a behind the music for Ray, but no, we're not going to do that.
Okay.
This is the place where we are going to answer all of your financial questions, and it's a great time to do it because, you know, the world's in disarray. Boys, I don't know if you realize this. And it's been kind of crazy. So let's just get off the ground here running with a question from Gordon, who asks, this is a good question, if the euro crashes and the banks are unable to sustain Greece, Italy, Spain, Ireland et al., is there any safe haven for investors? Jack, so far cash looks like a pretty good asset class, and the treasury market. What else?
If the euro crashes, European stock market plummets.
Yeah.
He needs to remember, I think it's 5 letters, VEURX.
Yeah.
That is the Vanguard European Stock Index Fund.
Okay.
If the market really crashes, I mean, European stocks are already priced for not quite Armageddon. Should they really crash from here and go down 10, 20%, that's going to be the sort of opportunity, I think, of the decade in terms of buying stocks cheap. I wouldn't throw all my life savings in there. Absolutely not. But, you know, if he's a guy who's mostly in cash and conservative stuff, I mean, heaven forbid he's in gold right now, you know, and gold would creep up a little bit should this happen, and then it would crash hard. So I would tell him to take an opportunity like that.
And Ray, what about if he wants to hide right now?
Well, you know, cash is a temporary place, but it's no long-term store of value here.
I'll say.
And there is no value that you're constantly losing money silently here. But to back up on this, you know, some individual stocks might be worth looking at too. Look at Vodafone, okay, or Telefonica, even some of the banks like Banco Santander. You have to look at what that happened, what would really be the effect here. But you're going to have an opportunity probably to pick up some stocks that yields that right now are in the 6 or 7% range might have dividend yields in the 9, 10, 12% range. Now, sustainability of paying that dividend is important and so on. Look at that. But I think that's opportunity. This goes back to where Warren Buffett said, you know, when other people are greedy, that's when you're selling. When they're fearful, that's when you're buying.
And Jack, do you think that we are kind of lining up for another disaster? I mean, how are you feeling these days?
You know, I think I'm probably typical. I'm a bit manic depressive on this. One day, I think, you know what? I think the market's a little bit oversold. This is lousy. We're going to muddle our way through. But then you do start to think about, okay, what would happen? Obviously, a lot of people in the market expect Greece to default. I think the bonds are getting 40 cents on the dollar right now. Right. But well, what if, you know, sometimes the market can't price in a liquidity crunch. So if there were to be a default in Greece and suddenly the paper of Societe Generale or SocGen or some of the other European banks was worthless, and a money market fund in the U.S. suddenly had to break the buck and say, you know, you have $100 in the money market, it's only worth 99 today. You'd see a run on U.S. money markets. So you can sort of picture scenarios in which, even though it looks bad right now, it actually could be a lot worse.
And I understand a lot of the money market funds have actually gotten out of these
You would think they're
European
doing
holdings
that,
because they are worried for that exact reason, right?
I don't think this is Lehman failing all over again, causing a $750 million piece of paper in the prime reserve money market fund, causing that fund to fail. I don't think that, because this is something that isn't happening as quickly. The financial crisis in 08 and 09 picked up speed so fast, and there were so many unknown connections here. I think this right here, as Jill mentioned, a lot of money funds have already managed to move away from paper in that market. Hence the high yields and low prices that you're seeing on that short-term paper in that market. So
you're very cool.
Yeah,
Ray's a cool customer.
Look, I think the monetary leaders understand what's at stake here. I think they understand a quick, massive liquidity write-down is probably going to end up in massive destruction of asset values, jobs, even loss of lives. Whereas a slow, gradual, grinded out over a 8, 10, 12-year period might be a better outcome from the standpoint that you give people time to adjust, businesses time to adjust to it.
It could mean the European market looks like Japan, though.
It could be.
Yeah, and maybe there won't be 17 nations in the Eurozone. Maybe there'll be 13.
I think there's too many moving parts to sort this all out. I think a giant liquidity TARP type, a real TARP asset fund, not a $780 billion bailout fund, but a real troubled asset program where all the bonds are lumped in, and then all the banks and monetary leaders take a piece of that and they have a diversified junk bond fund, if you will.
Who
Might
is
be a
not?
better
Let me
approach.
ask you a question. Who here is not scared of Angela Merkel? She scares me a little bit. I'm scared of her. I would not want to cross her. So I'm sort of feeling like she's wielding all the power. I feel like she's got like a whip in her hand. Like, just snap to it, boys. I'm running the show here.
Yeah.
Papandreou better feel that way, right?
Yeah.
You know,
God.
he needs somebody to.
I would say something very nasty right now, but we're in this nice family environment. Let's skip to a new topic. You know what?
Can we offer one? So we didn't fully answer the safety question. Even, I mean, we were saying, frankly, go for opportunity rather than safety. But I will advertise
when the time comes.
When
I
the
don't think
time
the time
comes.
is there
Just
yet.
ring that
I
bell.
think it will be. Keep watching that. Yep.
But I will say that Alan Roth is doing one of his periodic best CD rate posts next week on MoneyWatch. So I certainly don't throw your life savings in there either. But if you really want a flight to safety, take a look at that.
How can you buy a 2-year CD with a yield of what? One?
No,
or
you might as well just
whatever?
pay off your mortgage.
Well, the
Right?
Alan,
it just doesn't
actually,
make sense to.
Actually, what he recommends is you get a 10-year CD that has a small penalty. And so then you're getting 2.5%, 3%, and then if you
Maybe.
withdraw, you lose 1 or 2 months interest. But so what?
Well, let's
It's
move
still
into
not great, but-
some of these
right.
questions, though, because this comes into here's a great one from a
make
MoneyWatch user about 30-year fixed-rate mortgages.
Yep.
So as of this morning, 30-year fixed-rate mortgage, according to the Mortgage Bankers Association, 4.25% is the average. Let's say 4% for a 30-year fixed. Ray, do you think that rates will go? The question is, do you think rates will go lower in the next year?
Well, I'm seeing no points 30-year fixed actually on the street where brokers are not surveys, but where mortgage brokers are actually offering these, conforming all the ratios, credit score, and everything else. I'm seeing them in the mid 4s to low 4s, but not at 4.0. I talked at length to a fellow named Tom Wiseman, who runs a dozen or so branches under Prime Lending, about just this issue. What do you think Operation Twist will do to mortgages with the Fed buying in $400 billion, buying on the long end of the curve and buying a lot of mortgage-backed securities? Okay, and he told me he doesn't think this will drop mortgage rates much. And I said, how can that be? I mean, common sense would be if the Fed's stepping in and buying this much paper, they're going to drive the price of that paper up and yields down because you got a big buyer here. He said what he thinks will happen is the paper will be backed by the Fed, Fannie Mae, and so on, so government guaranteed. And it'll increase the supply of government guaranteed paper for lenders to go out and lend. And lenders, as a result, will reduce the loan-to-value standards. They'll allow people with 90% loan-to-value, 100% loan-to-value, maybe 120% loan-to-value. Somebody who has a home with a mortgage they're servicing, they have the income ratios, they have the job,
Right.
they have a good
underwater.
credit score, but they're just underwater, and they're not underwater by that much. They will hopefully, the door will open for them to be able to refi.
Wow.
He said that's what he thinks will happen. And I said, why do you say that? And he said, that's the chatter among mortgage brokers in the market right now. That's the kind of paper they need. They have a backlog of people that are just on the edge and could make it, and they're at 6%, and they could get down to 4 and make all the difference in the world.
Right. And but the appraisals coming in so
But
low.
the appraisals are killing people.
Yeah.
It's the appraisal that's killing people because there are no comparable sales.
Right.
And when an appraisal doesn't have comparable sales, they're not going to go call a new construction firm and say, how much does it cost to build that home? And the firm is going to say, it costs 1.5 times to build that home, but I'm appraising it at half the value because I have no comp sales.
Right. Especially
the
in those,
appraisals are the problem.
and especially in those areas where there's so many foreclosures. It's awful.
That is the problem. And he thinks that's what it's going to do. I'd like to believe it.
It's good for the economy, yeah.
It's a good story if it
would
does
be.
happen. It would be good for the economy
It would
because
be considering that all the HAMP and the mortgage modification plans have been
Right.
terrible and
Terrible.
really
Terrible.
just a waste of time and a lot of
Right.
and crazy making. I mean,
Yeah.
why does Elise get 1,000? Elise Glink, who writes our home equity blog, gets 1,000 comments on her mortgage modification. Hell, it is a crazy making experience for these people.
Right.
It's awful. Here's a question from Max. Here's a question. He says, "Is there any help for responsible homeowners?" Which he puts in capital letters.
right.
He's got the ability to pay. His income is above the 31% mortgage payment ratio, but again, loan balance is greater than property value.
There you go.
So he's really. Megan basically said, "You don't read the whole thing on air because the guy's mad." Max,
Screaming
we
mad,
totally
and I'm not going to take it anymore.
Yeah, exactly. He is Howard Beale. So the problem is that if you do get that appraisal, right now you're shut out, right?
That right now it's very difficult. What mortgage brokers are able to write is paper on $50,000, $100,000 loans, or the mega loans at $1 million, $1.2 million, $1.5 million, because those folks have the income to pay down, they have the income to justify, and the appraisal they can get down to the 80% loan to value. The people in the middle are getting squeezed, and he is an example of the folks in the middle getting squeezed, where I can service it, I have the income, I have the high credit score in the high 700s, 800, but I'm just not getting an appraiser to come out
so
and say my
annoying.
house is worth where it needs to be to justify the loan. And obviously, I'm staying in my home and I'm current on a mortgage at 6.5%, I could,
Certainly
I can
define
serve,
at
I can
4.5.
service one at 4.5, like it's easy,
That's
really
right.
easy. So
Well,
let's get it on.
Let
here.
me ask you a question. Carol asked a question about
sense.
she's a single mom and she wants to know where to concentrate her dollars. But I know that Ray, you probably get this question over and over again. Big issue here is, if you have the idea about paying your mortgage down, saving for retirement, or saving for your kids' education, and you look at those three, I'm going to look at you first because you have that exact similar situation.
I do.
I mean, there are some people who say, and maybe there's something to be said for this, that like, I don't really want to buy in the bond market. I don't really, but maybe I should take my extra dollars and pay down my 5% note because that's better than bond yield that I'd get right now, even with my tax deduction. But when you look at those three competing forces, pay down the mortgage, kids, retirement, where do you come out, Jack?
I would go with retirement for a couple of reasons. One, it's still liquid. If should you run into problems, that money is still there. Two, you need time. If you wait until your mortgage is paid off and your kids are through college, you can put away money for retirement, but you're not going to get that great benefit of compounding that you would over when you have a really long runway to save for retirement. Second of all, this is a cliche among people like us, but there are no loans for retirement. There are lots of ways to pay for college. You can get a grant. You can get a loan. Maybe your kid is a great basketball player. You can go to a cheaper college. I mean, there's all sorts of ways to do it. But none of those options exist for retirement. And what's the third one is?
So it's kids, retirement,
and then mortgage. It feels nice to live in your house free and clear. Everyone would love to be able to do that. But from a cash flow standpoint, from a pure mathematical standpoint, it's actually your third priority. There's a study that I love. Some professors from University of Texas teamed up with the Fed to look at what would happen if you invested in a 401k, pre-tax money, going into treasury bonds, a pretty conservative investment, versus paying off your mortgage. And they found that investment in the 401k actually netted you more money than paying off the mortgage. And that was, again, very conservatively invested. I think over a 20, 30-year period, stocks are probably going to do better than treasury bonds right now.
But Ray, let's say you had a client, a rich dude, because that's all your clients are rich dudes, whatever. And, you got a lot of money.
They don't start that way. But
I know, that's right.
They finish that way.
That's because they work with you, baby.
That's right.
So let's say, is it reasonable to say that if someone's got a mortgage, a 5% mortgage, that using some part of their portfolio to pay that down is better than buying a bond at this? Let's say a bond matures and they've got some cash in the account. So now you've got cash and you want it to be safe, you want it to be fixed. What about taking that money and paying down a mortgage?
Yeah, that's where I run the numbers, and it's a simple cost of capital or opportunity hurdle rate analysis. What's the after-tax yield on the investment you can make? What's the after-tax cost of that debt, and how does it compare? And it used to be, in municipal bonds versus a mortgage, you were really close,
right?
Or sometimes even the muni bonds were you could earn a little bit more,
right?
And you could earn an extra half a point or so it made sense. Now it's the opposite. With the debt cost is relative to any interest-bearing investment you could make. Paying off the debt is a better play than trying to invest that money in something investment-wise. But there's a lot of things to balance here. How much liquidity do you have?
Right.
What do you do to your balance sheet when you do that? You want to stay liquid. You want to make sure you're covering all your bases. You don't want to just lump into one strategy. It's sort of easy to go with the pay off the mortgage, but building a liquidity fund for somebody, paying off other debt that you have, and saving for retirement. And then if you got room, a little bit more for somebody's college education.
Makes sense.
Yeah.
And there's always the possibility that we'll face inflation in the coming decades.
Right.
And if so, that mortgage is going to look cheaper and cheaper. Granted, some investments might get hammered, but a diversified portfolio is probably going to do a heck of a lot better.
Mortgage money now is so inexpensive and likely to get a little bit less.
Here's a question from Jim. You're going to like this one. It's just one of those fun, mathematical questions. My income is above the allowable limit for making a contribution into a Roth. However, there's no income limit for converting a traditional IRA into a Roth. Is it legal? I like when we get a question like that, to make a non-deductible contribution into a traditional IRA and then convert it to a Roth the next day.
Yeah, absolutely is.
It's totally legal, right? I looked it up also because I wanted to make sure. It's a backdoor way,
It's a backdoor loophole to have a Roth IRA if you don't.
But it's not. Does it raise an audit flag?
No.
That's so cool.
Nope.
There's one word of warning, though.
Yeah.
Remember, if he's got a big traditional IRA sitting out there,
you got to pay the
on that.
Yeah.
People don't realize it's not like you can just take 10 grand, put it, and flip it the next day, you're going to have to think about the liability that you have on that other IRA.
That's right. But
Wait, can you explain that more? So, because I just want to make sure everyone gets that.
I know, what I don't know is what the percentage is, and Ray clearly knows that number. But my basic point was, it's not as if you can just isolate that money. Say it's $10,000. He wants to put into a traditional tomorrow, convert it to a Roth.
Right.
He's going to have to pay some tax on the existing IRA that he's not converting, and Ray can tell us what that percentage is.
Well, you have to take all IRA money that you have and proportionally look at it as one giant conversion.
Okay.
And then the piece that you convert, that $5,000 piece he converts, what proportion is that to the rest of his IRA money? And that's how much of unrealized gains proportionally. It might be 10% of the unrealized gains or 2% of the unrealized gains you have to pay income tax on. So there's a phantom tax, but he has no other.
But if he has no other IRA, there
Perfect.
really is
great,
nothing,
yeah.
right?
Or a
That's
small
the best.
outside
right?
IRA,
Yep.
perfect. It's a great backdoor way
good.
to
I just want to make sure we
start that.
clarified that.
Yeah.
Okay.
Or better yet, contribute to a Roth 401k if he has one, because there are no income limits on making Roth contributions to a 401k.
But it will get in the way of his, which I found out the hard way. It does count against your maximum 401k, not allocation. What's the word?
Contribution. Yeah, you mean the
your
16.5
and
Right.
your other 5. But what I'm saying is you can contribute a lot more that way. If you like the idea of Roth contributions in a retirement account and you're income limited and you're trying to do this backdoor method, look at your employer's 401k. If it has a Roth contribution feature, you wouldn't believe how many people don't realize that or don't pay attention to it.
It's good to know.
Look at that, because they're ingrained. Pre-tax contributions 401k all the time.
Yep.
Roth contributions 401k are a
Anne
better way to
says
go.
she read somewhere that 401ks are only worth opening if you make over a certain amount. Jack, could you please dispel Anne of that myth?
I'm guessing, let's go to the kernel of truth. She probably saw that the more you make, the higher the deduction.
Right.
So if you make more, you have a bigger tax advantage for putting that money in a 401k.
I would say she's right. If you earn at zero, then it's not.
Well, right. Zero is right. If you have no earned income, it's probably not a good thing to try to do.
Because you can't.
Right.
Other than that, right?
And you could also make an argument that if somebody, maybe the Roth 401k is, if tax liability is not an issue, and let's say you've got income of 30 grand or 40 grand, maybe you want to do a Roth IRA. You're well under the limit, and you'll have that nice tax-free growth.
That's true.
So
unless you have a
match. Yeah.
Right.
So your first money absolutely has to go into the 401k to get the full company match. After that, think about maybe opening a Roth.
Or Roth 401k. Again, back to that.
Yep.
Many 401k
Okay, by the way,
plans
this
offer
is
that.
Ray's favorite thing today.
Apparently,
Yeah,
Obviously.
I'm
Okay,
on the
Barnes
kick.
wants to know, he's got a 401k account and a stable value account. How lucky for you, Barnes. You're a brilliant man. I haven't lost any money since investing there. My question, is there anything else to consider putting my 401k into that will make a little more interest than the, get this, Ray, 0.3% that it's now making, and still be assured of no or very little losses? So wait a second. So clearly Barnes says, I hate risk. Okay. I'm willing to take 0.3% because he says, I want no or very little losses. I've considered an annuity. On one of your prior programs, y'all didn't think it would be the best time to do that with interest being so low. Should I sit tight and wait it out?
Well, no. No word.
Wow.
But that's because he understands market risk, as we all do in spades. We've just seen a lot of market risk. Anybody with money in the stock market in 08 and 09 lost half their money. So we're all scared of that. But what he's not considering is inflation risk. 0.3% is a guaranteed way to lose money. You'll lose it really slowly. You won't notice you've lost it, but 20 years from now, you're going to realize that your purchasing power is way down. Now, granted, that stable value fund is going to probably yield a little more in 10 or 20 years when inflation picks up, but still, you've got to balance out your risks. So, okay, for market risk, keep some money in bonds and stable value, but also worry about inflation risk. So there you're going to want tips. You're going to want stocks, which do okay. He's got to take the stomach or develop the stomach to take a little bit of risk. I wish we knew his age.
I know.
Because we could answer this question a lot better if we knew how old he was.
I'm going to back up the truck here for a minute and say, why is a stable value fund and an employer's 401k
I
plan
was just
paying
thinking that same
0.3?
thing.
Because I'm telling you, in the marketplace, and I survey employer plans on these, they're in the 2 to 2.5% range, 250 basis points to 300 basis points.
Is it possible he means the money market?
It very well may be. He may be confusing this. Or, I think.
Because a stable value should be a couple
will
percent.
have a couple, 2 to 3 percentage points, particularly a plan like at Boeing, where they have broad negotiating power, a $26 billion, $30 billion plan. They're going to get a variety of stable value funds all collecting in one fund, and they're going to have a yield much higher than that. However, the Fed came out and said, what? We're going to keep interest rates
Till
extraordinarily low until
2013.
mid-2013, right? I mean, don't like the idea of it, but short-term bond fund for a while. I mean, basically, they told bond traders, we're not going to cut your knees out from underneath you. You can go buy short-term paper right now.
Right, relax.
You might be able to watch it for a little while, but look at short-term bond funds in your 401k what they're offering. You might get a better 1, 2, 3% total return here. If you look at the year-to-date returns right now, they're actually looking pretty better than that. But you got to be really careful because at some point that's going to turn against you. So you got to pay attention to it.
Dick wants to know in the chat room, were you headed for a crash in the price of gold? I think we just saw a little mini moment there.
about that?
Jack, weren't you asking me about when you should buy gold?
Commodities in general,
Okay.
actually.
Well,
yeah.
soon, maybe.
Okay,
I don't know. And Dick says he doesn't seem to be like gold's acting like a hedge on inflation. You know why, Dick? It's not. It's not really, because it never really is. It just lost that as a hedge.
Yeah.
It has been the panic trade. It's been the panic trade for a while. And then when everyone got their margin calls last week, it was like, whoa,
Yeah.
I'm going to lock in my gains. By the way, gold's still up about 13% on the year. So, I mean, I think a lot of people are saying gold's going to either it's probably not going to 2,500 and it's probably not going to 1,000 anytime soon.
Yeah.
It's going to trade in a range. I think that it's going to take a breather here for a while.
Yeah,
but-
speculation is another currency, right? I mean, if there's some other basket of currencies, including gold, that could replace the U.S. dollar in its stature in the world, I mean, that's...
Yeah, you could
that's
buy an
issue.
emerging, but you could buy an emerging
Who the
debt fund to
heck
do that if you
knows?
really wanted to.
Exactly.
Right?
That would be I think that would be a better way to play it.
There's a really good, actually, I think there's a Vanguard emerging debt fund, the no-load fund. It's a pretty good fund.
And Templeton has a good global bond fund as well.
The old Templeton funds,
Yeah,
the
but
Franklin
their
Templeton.
fees and loads are a little...
Yeah, they're rough.
But they're good.
Yeah.
They know
Remember
what
the
they're
old
doing.
Franklin balance sheet? I used that fund 100 years ago. Solid, boring.
Loomis Sales has a good international bond fund, very volatile. It just
You know,
takes a lot of risk.
An
but-
interesting fund to look at these days, too, is the permanent portfolio. I don't know if you PRPFX, I think is the ticker symbol. It's a basket of metals, metal producers, gold, some treasury paper in there, and cash. And the guy moves it all around. And
Kind of cool stuff. I'll tell you what I really would not be interested in buying right now. I know I obviously have no guts, but I could not really go out and like swing for the fences and buy financials right now.
Yeah.
And I just saw Bruce Berkowitz from the Fairhome Funds.
Yeah.
He is like making a massive bet. The guy's going to get really rich or blow out of this fund, but it's huge.
Yeah.
And
Book values.
that's
book
his
value, right? It's
That's
all about
his
book
whole
value.
story is book value, and that these guys could stop doing business now, and they'd like be in business for another 5 years.
Yeah.
And it's scary though, isn't it, Ray?
It really is. I mean, it's hard to trust book value because who's telling,
Right,
who's
which
telling us the
book?
value of those assets really are? Because we learned all about that in the last couple of years, didn't we?
Did we say 100? We meant 50.
Right.
Berkowitz has been on this trade for
Yeah.
a long time now.
Yeah.
He was really early. We'll see if he was right or...
I think what concerns me is the flattening of the yield curve with the Fed's Operation Twist. Not exactly a great environment for banks to make money
No.
now.
Yeah.
They can lend it for and they pay interest at what the spread is tightening up
Yep.
here. So still decent spread, but that's not exactly great for banks.
No, we
right
need
now.
growth. We need growth.
And there's an awful lot of
loan growth, good loan
bad
growth.
stuff on their books.
Yeah,
Right.
there still is.
They
I
just
think that
haven't
like
taken the hit yet.
and the litigation that's pending and bubbling up around that whole mortgage stuff makes a few of those banks particularly at risk. Bank of America. Okay,
Yeah.
Lara from Texas says, my husband and I are both school teachers, and we have triplets. Zoinks! At one point, I had to quit work for a year and a half. God, I wonder why. We accrued some debt during that time, and our credit rating fell. I've been back at work for 3 years. We live paycheck to paycheck, but our debt has gone down substantially. In 4 years, our children will be applying for college and for student loans, 3 at once. And you complain. And you complain, mister. By then, we should be debt-free except for our house payment and minimal car payment. Will we be able to qualify for parent loans for our children's education? 3, Ray. 3.
Wow, their expected family contribution in the federal student guidelines for aid, they should actually, with 3 at the same time.
They should pay them.
Wow, yeah, they might ring a bell here. They might be kind of hit the student loan and parent loan lotto here as far as
But they should be okay.
eligibility. It just sounds like it should in that scenario. You don't know all the
Right.
specifics and details here, but it sounds like they should be okay here.
Yep.
Right?
Yes, and I think that when she
yeah,
talks about paying off the
absolutely.
debt, I think their credit rating's probably going to be is probably been improving. Just make sure you're not opening tons of credit cards and doing all sorts
Yeah.
of stuff
But
in
the
that
kids would get
period.
student loans, and then the parents could get plus loans. Right?
Absolutely.
Right.
Or you could do the Ray Martin, which is kick your kids out, tell them to educate themselves, and move on.
Yeah, I'm not. Look, as a parent, do I intend to do that to my kids? But no, but there, Jack nailed it earlier in the segment, okay? There are lots of ways to finance an education besides just loans. There are work studies. What's wrong with working through college?
Absolutely.
Okay? What's wrong with starting at a community college or low-cost schools while you're figuring out what you want to do and learn what your study habits are really going to be before you upgrade and go to a more expensive school? So there are lots of different ways to swing it up there, folks.
And Jack, I was really kind of just knocked for a loop when I was interviewing John Alzheimer, who's a credit expert, and he was talking about student loans and really how devastating student debt has become, and the pressure to really pay that off for these kids is amazing. And of course, you can't declare bankruptcy and get your slate wiped clean when it comes to student loans either. So there seems to me like something's got to give. Do you see that happening, or is that not happening in the future?
Well, I think it has to at some point. I mean, it's just like Robert Reich has tracked the progress up to the financial crash, and he points out the various ways that families in the middle class coped. And first the woman went back to work, and then women went back to work, or went to work, I should say. So suddenly you had a dual income family. Then hours got longer and longer. Then people took out debt on their credit cards, and they kind of maxed out all their options, and then we had a financial crash.
Right.
I think with college, you saw prices twice the rate of inflation for 10, 20 years now.
Yep.
You see people doubling down on student loans. At some point, they'll be maxed out. They simply will not have any options. And I think that these colleges are going to have to lower the price. I once complained to my alma mater about that. They were actually trying to get me to help them raise money, make the phone calls, do all that stuff. And
Did you remind them that you're in journalism, not in finance?
Well, that's my deal with them. It's like, I'm not going to give you money, but I'm a journalist, I'm a communicator, so I'll help you raise some from my rich classmate friends.
That's awesome.
But I said, look, I do have one concern. And I said, I just got the letter from the president saying that you guys had held the tuition increase to 6% this year. I said, inflation at this point was running about 2.5%.
Right.
What gives? And I hated the response. She said, we will charge what the market will bear, and right now the market will bear this.
Wow.
And I was really upset that she said that, because we know how difficult this is for parents.
So in fact, if we really didn't have student loans at all, the price of tuition should fall dramatically.
Absolutely.
Or there would be enough rich people to pay a certain amount in certain elite schools, but even their dumb kids would be able to go somewhere.
My father paid full fare for me and my brother, and he said he wanted a tax deduction for the value of all the kids at the school who were getting a break.
It's very nice.
And it's not an insane idea.
Well, a portion of my tuition is a gift.
Yeah.
Right?
Oh, I like
Right.
that.
Isn't that interesting, right?
And isn't that true? And Ray, isn't that a nice way, let's throw a little estate planning. If you're a rich client like Ray has, because he made you rich. Okay, there you go. That is one cool thing that you can do, by the way, to give your money away. You can write a bill directly to an institution.
Yeah, there is
and that's outside the gift tax rules.
There's the unlimited.
That's an easy
gift
way to start
amount,
giving a lot of money away. 50 G's a year.
Pay the check directly to the education, qualified education institution, or for medical costs directly to the medical service provider. But going back to this, there was a belief in this country, and I think it's being finally challenged, that it really doesn't matter what you pay for an education because it's worth it. Mm-hmm. Okay, and that's just not the case. There's a cost-benefit analysis, and people have lost sight of that when they'll pay $50,000, $60,000 a year for a child's education, $250,000, and the child gets out of school earning $30,000 a year in a profession where they're probably going to be capped at 70 or 80
Yeah,
grand.
it's rough.
Think about the economics of that. Are you kidding me? Then what you really did was pay for an experience that had nothing to do with helping their earning power. Okay? You've got to think about the economics of what you pay and when you get out. And student loans that are unsustainable, they're toxic debt. It's the only loan you can get where you don't have to have any income, no assets, never having had a job. You can still get this loan. You can get into more debt than you'll ever be able to pay off in your life, and then when you get out of college, you're crushed by it, and then it hampers what you're going to do for your career for a while, because all you're doing is trying to run around and pay the loan.
So at the very least, you have to do the math and figure out what your monthly bill is going to be when you get out. You've got a post that does that. You took a $24,000 loan and you explained
absolutely
what it's going to cost.
You should know your total cost of your education before you start your freshman year, and you should know what your monthly payment's going to be when you graduate before you start your freshman year, and decide how much you're willing to pay, set a budget for that, and don't go over that, and then buy the education that fits that financial situation.
Yep.
End of story.
And kick ass when you're in school so that you can, right?
Yes.
That's the deal. You just, I mean, you
Treat
can't.
it like an investment,
Yep.
not a social experiment or experience.
All right, let me just do one last.
That's my
That's
view.
it. Damn it. Okay. Do we have any more? Let me just do one more question here. This is kind of an interesting one. Don wants to know how credit unions have fared in the aftermath of the economic crash and bank bailouts. Can they overcome not being part of the bailout? And I would also ask Jack, are they financially strong enough to go forward here and keep offering the stuff that they have been offering, which has been kind of interesting?
You know, I don't have the current numbers at my fingertips, but I looked this up a while ago, and I remember at this point there had been, I think, 136 bank failures and 4 or 5 credit union failures.
Interesting.
It was incredible, and I suspect that ratio has probably stayed more or less the same.
Right.
Because these are nonprofits, and they did not have, I sound like a politician here, but they didn't have greedy bankers piling on the bad mortgages in the full belief that they weren't actually going to be on the hook for these because they were sending them off to investors. You know, credit unions didn't play that game. So if you'd looked at the profits in 05 and 06, they wouldn't have had any.
Or investment banking, or mortgage securitization
Right. They didn't have that whole that side other
that Graham
businesses,
Leach flywheel
trading.
breaking on all apart, and then banks being able to just, the Citigroup model, being able to do everything.
Yep.
I think took banks' focus off what their fundamental business is, which is banking.
Yeah, they forgot about that.
So credit unions emerged in much better shape.
Banking.
Yeah, and they're in good shape, and they offer some really good stuff. And it's a lot easier to be a member of a credit union these days. Megan produced a great piece for us about credit unions, and we've done a lot.
Penn Fed, I looked into this. All you have to do
Yeah.
is you send $20 to a fund that supports families of soldiers. How could you not want to do that?
Right.
You're a member of Penn Fed, and everything, all the rates are better. If you're in terms of the interest that you get paid as in your savings account at a what's the word here?
Bank?
Credit union.
Bank
is
union.
higher than you get at a bank, and the rate you pay on borrowing is lower.
Yeah.
And
Good
the fees
deal.
are lower. Yeah.
It's a good deal. Do
So-
you belong to a credit union, Jack?
I do not. You
Uh-huh.
know why? You know why? Because it is such a pain to switch.
That's why
banks
they
are
have
so sticky.
they've really done that to you, haven't they?
Now, what I do is I negotiate, because what the banks do is they're always switching you what the best rate is. One day it's the money market, the next day it's the Super Saver account, the next day it's the Super Saver Plus account.
Who has time to do
So
all of this?
It takes less time than switching your bank account. you know.
Exactly.
I like Bank of America. I love the website. Love the
They
bill
have a
pay
great
option.
website.
Great website.
Great
Isn't it
website.
awesome?
It totally is.
And
I
there's-
agree with
bill
you.
pay
That's
is
the-
awesome.
the
and
biggest
a lot
problem
of
with credit
ATMs
unions.
around, and
Yeah.
Is the websites aren't up to snuff.
Bank of America has an awesome online
It's all about that,
interface.
baby. It's all about
Good,
that.
go Brian.
Go
Come
pay-
on.
come
Brown
on.
University graduate, I might add. Let's close it up here today. So Ray
Was
Martin.
his education worth it?
I guess in his case, his brother's a priest. So interesting.
He needs God on his side
I
right
was
now.
gonna
Oh,
say, yeah.
yes,
Maybe you
he
can put in
does.
a good word for him when the day comes. 'cause-
We're going to close the show down. It is the evening of Rosh Hashanah for me and for our... What is Sally's title, Megan? Yell it out. Producer, production assistant. So Sally, who's been running the show, who's fantastic. Happy 5772 to me and Sally, and to you if you are of the Jewish faith. And you know what, Ray? To you as well. Why not?
Wow.
We're having a New Year's Eve party. Come to my mother's house. We're having a little brisket. Ray,
Hey,
thanks so
you
much
can
for
party with the best of them. I'll be there.
Oh yeah, thank you so much for joining us, Ray,
You're
and
welcome.
Mr. Jack Otter.
I'll be celebrating too, as you know.
I know Jack will be celebrating with not having to move his car tomorrow here in
Yep.
New York City, which is an excellent thing. And we will see you next week. Thanks so much for watching Ask the Experts, and send us an email, asktheexperts@moneywatch.com if you have any questions. We'll see you next week.